The market has done better under Democratic administrations. And the conservatives would tell you, well, that's because we would have to come in and clean up all of the excesses, the excess spending, the excess monetary stimulus. And that would mean a crackdown on certain businesses, which would be bad for the market and bad for psychology. Seems like it's the opposite here. I have never seen fiscal outlays, federal outlays, down at a double-digit rate in a midterm election year or a national election year, and yet here we are, down year over year, and I have never seen monetary restraint, the likes of which we're seeing now, in a midterm election year. In fact, historically, during election years, midterm or the national elections, we saw Federal Reserves basically saying to themselves, perhaps, but it seemed like we observed their actions to be, okay, get all of what we need to do out early in the year so that we're not accused of being political. And that has not happened this time. In fact, at the time in past Fed regimes, that they would be basically going neutral, just status quo, that probably would have been around February, March of this year. And yet that is when the Fed really started to crank up interest rates at a rate we have never seen historically. Never. We have never seen this. Many people equate what happened during Volcker's years as similar. Volcker was really trying to throttle inflation and raised interest rates from roughly 10% to roughly 20%. That's a twofold increase. With this week's action from the Fed, another 75 basis points, the Fed has taken interest rates up 16-fold in less than a year. Never been done before. And I think we're going to see the fallout during the next year. And when I say that, I mean it will be a cyclical fallout. And I think it will benefit those companies that can grow through this period. And as we said all during COVID, innovation solves problems. We have so many more problems now. Supply chains loosening up, but still we have the war in Ukraine. And now we have fiscal and monetary policy really tightening in a way that businesses are going to have to change the way they do things, increase productivity, cut costs, and so forth, in order to navigate through this very difficult environment. We think that will accrue ultimately to those companies who facilitate those kinds of productivity moves, cost controls, and so forth. Primarily, the early stage of the pipeline, from an innovation point of view, commodities falling dramatically, and we'll get to that in a moment, and the fact that inventories are overwhelming the system, and I think we'll see that in terms of huge discounts at Christmas. Even the Fed's own that there are regional territories where the Fed engages with business leaders. There are 12 of them. Even these, I know they're not called territories, I think they're called banks, are showing in their monthly indicators. So the Empire Fed puts one out, the Philly Fed, Richmond, Kansas City, Dallas. And these are quantitative indicators. They may be subjective surveys, but they are subjective all the way along. And they are hitting the skids one by one. Negative territory, negative. I looked through the last month's worth, and all of the banks that I just mentioned we're showing increasingly negative sentiment about economic activity in their regions. And prices actually falling. And we did see that in the Purchasing Managers Index. Prices paid index showed negative prices. And again, we'll get into that in a minute. So money now, M2 growth peaked at 27% in mid-2020. And as of September, it was down to 2.6%. It looks like October could be below 2%, maybe 1.5%. And effectively, money is falling. Money, if you look sequentially, is falling. Now, the only time we've had a sustained decline in money on a year-over-year basis, again, we're not negative year-over-year yet, but that's where we're heading, was during the Great Depression. And hold that thought, because I'm going to describe why we're not in the environment that the Fed thinks we are, which is the 70s. And the reason is, I think I set this up in the last YouTube video. In the 70s, when Volcker inherited a very bad inflationary situation, so inflation was moving into the high single digits, low double digits, mid double digits is where it peaked. So he inherited that, but it had taken 15 years for that inflation to move to those levels. Now, it started in April and May of 1964, Vietnam War, Great Society programs, the Johnson administration putting into place many, many, many social programs at once. And it was a period called guns and butter, so spend on everything, which they did. So we had fiscal policy moving really out of control, and monetary policy accommodating it. And also, as we went off the gold exchange standard in 1971, we closed the gold window. That was the last semblance of discipline in our monetary policy. That was 1971, as I said. You know, all hell broke loose. We had OPEC quadrupling oil prices. We had the Fed accommodating those oil prices, which eventually got into all kinds of indicators, including wages. And you'll often hear the expression cost push inflation. It comes from the 70s. The cost push was wages pushing through. And I think this time is very different.